Fair value gap trading strategy tutorial guide. This is the part 2. In the part 1, I showed you how the fair value gap candlestick formation can be formed on the trading chart. I told you for a fair value gap candlestick formation to be formed, we need 3 candlesticks altogether. Now, for you to find out a real fair value gap, we need to ensure that the highs, lows, body of the first and the third candlestick, or any of the first or the third, does not push into the body of the second candlestick. Once you can find out these characteristics, then it means we have a fair value gap. But if the highs, lows, body of the first or the third candlestick push into the body of the second candlestick, then it means we do not have a fair value gap, or we have a used fair value gap. Now, in this tutorial today, I am going to walk you through on how to mark strong and weak fair value gap, the one you should trade and the one you should ignore. If you are yet to watch the part 1 of the fair value gap, which is the introductory, please kindly refer to the links I left in the description of this video. Also, ensure to subscribe, like, share, put a comment down, tap on the notification bell so that you stay updated on this YouTube channel. You can as well use the links I left in the description of this video to register today on a reliable and trusted brokerage firm. Using the link, make sure to qualify for a 100% deposit bonus offer. With that being said, let's dive straight into the fair value gap trading strategy tutorial concept. Now, let's look this chart right here. I'm going to go to the day chart, and you can pick any random chart you prefer. So in this tutorial, let's choose a liquid market. So I am going to wipe out everything here, and then as you can see right here, this is the day chart, right? And then staying on the higher time frames helps you to identify reliable strong fair value gap. We all know we need 3 candlesticks to find out our fair value gap. Now let's study what we have on this first, second and third candlestick. You can see after we got the first bullish candlestick, we got the second, we got the third. Now let's mark the close of or the high of this bullish candlestick right here, and the low of the third candlestick right here. Now as you can see, the empty space between this first and the third candlestick is what we call the fair value gap. So this is our fair value gap right here. So the concept or the ideology behind this marking of these difference highs and lows is that whenever price comes into this level, there's a higher tendency for this level to act as a demand for price in this upward rally. But this doesn't mean you're just going to mark any levels or any fair value gap on your chart and start trading them for buy or sell. I'm just showing you what the fair value gap is all about. Now let's go to the side right here, whereby we have bearish candlestick. You can see if we mark this is the first bearish candlestick in this sell market, we have the second and we have the third. Now let's mark the close of the first bearish candlestick, and we mark the highs of the third candlestick. Now the empty space between the first and the third, which is on the third or second candlestick, is what we call the fair value gap. You can see that. So it is likely in future, if price comes right here, there will be a kind of a sell reaction coming in to push the price all the way down. Now this is how we mark our fair value gap, but not all fair value gap you mark in the market you are going to trade as a trader. If you mark that, you are going to waste all your trading capital, because not all fair value gap are truly fair value gap. Some are just trap, right? And some does not have confluences. So for us to trade fair value gap in the market, we need to look out for confluences in the market. Now let's check the ones we have right here. You can see right here, let's zoom in, we have 3 consecutive candlesticks. We have the first, second and the third. Let's mark the high of the first candlestick and then the low of the third candlestick right here. You can see that. So let's extend it to this level. You can see when price came into this level, you can see how this level acted as a strong support for price, and then price was being demanded and price went all the way up. Now let's find out why this level acted as a definite demand or support for price. Now, not did only this level right here give us a fair value gap, but we also had some confluences right here. You can see we have a supply level coming in at these zones right here before price went all the way down. Now you can see from this level here, you can see we have a kind of a supply here, and then when price broke this resistance structure, price went up, it went high to these zones right here, and price crashed back into this zone. Now a fair value gap formed right here, or the fair value gap formed right here, also aligned to a breakup structure in the market. There was a breakup structure, and then if we are to study the last higher low in this uptrend market right here, or this is the last higher low right here, we fired our trend line to the downside, we can see we have our higher low swings right here. Now the application of our Fibonacci from this higher low to this peak of this higher high right here, you can see this level of the fair value gap acted as the middle of the discount and premium price level. So this is another confluence factor right here. Okay, and you can see this level right here. It's a level whereby we have a true break of change of character from a downtrend to an uptrend market structure. So for us to trade a fair value gap, we don't just want to mark any fair value gap that we see on our trading chart. And they're extending this supply zone to the left hand side. We are going to see from the previous price actions on the left hand side, we can see this is a very strong key level zones, whereby we add it right here as a demand or support. Price broke right here, we fill in this level again. And then if you can pay attention right here, you're going to see we have a kind of a fair value gap right here as well, which the price filled before the price went all the way down. You can see that after price got right here, we came down, we pushed back. Now let's study this again. Now you can see I told you right here that this was a previous supply or resistance which price broke with the fair value gap, and after price broke it, price retested it to validate this level as a new support, and then in conjunction with our bullish fair value gap, right? And then you can see the support we had right here. Price broke our support. Now price pushed back, and the level whereby price got rejection was the fair value gap right in this medium right here. You can see the empty space between the bearish candlestick we had right here. You can see the small bearish candlestick, the third small bearish candlestick, and the second bearish candlestick was a very big volume. Now this was the volume that pushed into breaking this support structure right here. So this is a break and retest, but not just an ordinary break and retest. There was another confluence factor which are fair value gap or a bearish fair value gap. Now for you to trade fair value gap in the market, I am telling you, you have to combine them with other confluences in the market. The more confluences in the market you can see supporting your fair value gap, the higher chances the fair value gap is going to work out in the market. So it is not just about marking everything you see on your chart and then having the hope this is a fair value gap, then you are just going to trade everything. Now let's look out for more examples of fair value gap and see how confluences we are able to validate them. Now we are going to wipe out this chart and they'll see another level we can see fair value gap. Actually the fair value gap we had right there is yet to be taken or to be used. Let's just mark it down. So we mark it down right here. Let's zoom in. You can see we have the highs of the first candlestick and the lows of the third candlestick, and this level right here is actually a break of structure. You can see price was going all the way down. We broke this level right here with the fair value gap, and we are just going to extend this level right here to this zone right here. So which means in future, if price should navigate to this zone, we are going to carefully study the price reactions. And it's not just about trading from this level to the upside. We also need to see market structure forming at this level. Can we see a switch of market structure, such as a low high, lower low, low high, and then break of this low high to give us a change of character before we are going to look for a buy right there. So guys, this is how you use fair value gap, right? I'm still going to continue the part 3 of the fair value gap. If you would like to see the part 3 of how to use the fair value gap as a professional trader, the right way, ensure you put a comment down you like, right? And let's study the last fair value gap right here before we put this video to an end. Now you can see the fair value gap we got right here. Let's see it out. We have the first candlestick, which is a bullish, we have the second, which is a red, and the third, which is a bullish. So we have a distance between this first and this third. You can see the distance right here. And then there's another concept I'm going to introduce you guys to, which is the order block concept, which when you combine them with your fair value gap, it does give you a very strong trading concept. Now you can see right here, from this level of this support, we broke this level to the downside with this massive bearish sell candlestick. And in future, after price move into this fair value gap zone, we can see this level acted like a kind of a small sell for price. It was a kind of a it wasn't a massive sell. No, market didn't move for a long period of time before market pushed up. Even though market didn't push up, there was still a kind of a little sell. And this is why you always have to trade with stop losses in place, because there is no trading strategy which is infallible in the market. So this is why you need to always use stop loss. All right, so go over your chart and mark out what you can see, empty spaces you can see. They necessarily don't need to be 3 consecutive bullish candlestick or 3 consecutive bearish candlestick. They can be combination of bullish and bearish. But what really matters is that for you to trade a fair value gap, they must be in direction of the trend, and then you must be able to see an obvious spaces between the first and the third candlestick, right? For example, right now, the one we have right here, you can see we have right here a bearish candlestick as the first, we have the second right here bullish, and the third bullish. Now from the high of the bearish candlestick, which is the first, to the low of the third one, you can see right here. You can see now, study the high of the first bearish candlestick right here and the low of the third candlestick. You can see we have an empty space, and when this doji pin bar field push into this empty space, you can see how the price went up in a massive profit reward. Now this fair value gap was what validated a strong buy to break the resistance or the supply level or the higher high right here, which led to a break of structure. So this is how you can use a fair value gap to, you can mark it out on your chart, you mark it out, you use it to find out confluences in the market. So this is the part 2. In the part 3, I'm going to walk you deep down on how to combine them with other factors on how to use them to execute trade. If you'd like to see the part 3 of this fair value gap trading strategy tutorial guide, please kindly put a comment down, like, share, right, and subscribe. I don't want a kind of too long video. I want to break it into sections so that you can follow the concept tutorial in a sequential manner. Right, I'll see you in the next one. Peace.